Hey, good afternoon, everyone. Just setting up the charts. Traders are coming into the room. I will be ready in about 60 seconds, and we're going to start. Hey, good afternoon, everyone. Thanks so much for giving me your time. And I really think you're going to see a Forex system that's really different from anything that you've encountered before. It's extremely powerful, and they have a lot of traders on it, and it's really going to get you precision entries. I mean, from a coding standpoint, it's fairly complex, but I'm going to go through it with you, and I just hope it's not too much information, but I want you to understand exactly how the system functions. Now, let me quickly read the disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. We here at the company don't take responsibility for any money that you win or you lose. You know that trading is risky, and that you can lose a substantial amount of money. Hopefully you'll make a lot of money, but don't risk what you can't afford to lose. Always carefully consider your financial position prior to making a trade. You may want to do your own due diligence. And those of us here at Right Line Trading are not registered financial advisors, and we're not licensed commodity trading advisors. Now I'm a little bit hoarse because I just finished trading the futures markets. And this week I've probably talked about 30 hours in total in the live trading room. So I've actually gotten hoarse from it. So let me just take a quick drink. Now, the state of the art of the markets today are very different than when I started Right Line Trading 10 years ago. Digital marketers hadn't come out of the woodwork like cockroaches. Now they're all over Facebook, YouTube, Instagram. I have them on every one of my data feeds. All of them have made, 15 or $20 million trading their software. Now they're offering it to you for $2,000 or $3,000 because they're philanthropists and they want to send the ladder down. They all say the same thing. I'm going to send the ladder of success back down to you because I feel morally obligated. I don't want to distinguish myself from them. None of them have any formal training. A few of them say we're on the floor of the Kobe. Some of them lie and tell you they were hedge fund managers, which is a bunch of baloney. But as a small part of my resume, I had graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years. I majored in applied mathematics. Right after I graduated, I was inducted into the Phi Beta Kappa Honor Society. It's a national society. You have to graduate in the top 2% of your class. I was a full-time professor at Jefferson College in Philadelphia. It's on Walnut Street. I think it's been so many years. And I used to be able to walk to work. It was only about 6 blocks from my house. I lived on South Street in Philadelphia. While I was at Jefferson, I published I loved being at Jefferson. I published 15 peer-reviewed articles, and I consider myself first and foremost to be a scientist, a teacher, and an academician. And I left Jefferson for personal reasons, or I would still be there. Now, I've mentored more than 30,000 traders, and I've spoken internationally in many, many countries. The last place I spoke was in the Philippines. And I was there the end of April, first week in March, or the end of March, first week in April. And I just got out of there in time. When I was leaving, everyone was just starting to wear masks in the airport. And that COVID Chinese flu or influenza was just about to break worldwide. And if I had waited probably 2 more weeks, I'd still be in Manila. The Filipino people are really, really sweet people, really kind. But I would rather be here than I'm more in South Florida than in the Philippines. And it's a 30-hour flight from here. It is so long. I mean, it's like it's like interstellar travel. Now, let's talk about day trading and swing trading. And we can look at any market that you want, stocks, futures, or forex. Now, this is uniquely true to the forex markets. And what do most traders in the forex trade? They trade price patterns, price action, Fibonacci, and a whole host of other things we're going to talk about. Now, 95 to 98% of forex traders have been going bankrupt for the last 40 years. And that number has not improved. And the reason it is not improved is that for some strange reason, academic institutions do not look at day trading and swing trading as a scientific discipline. Like there's no formal department of trading. I mean, at Penn, I took classes at Wharton, and Wharton's one of the best business schools in the world. And they're not going to teach you anything about how to swing trade or day trade. They're not going to look at indicator analysis. You know, they're going to teach you about macroeconomics and about you know, supply side economics. You're not going to learn about this discipline, and I think it's being sorely neglected by academicians, because for all intents and purposes, we're in an academic area. And what we need to do is what every other area of scientific discipline does. And if you take medicine and you take architecture and you take electronics, in the last 40 years, we've made such enormous strides in those areas. I mean, I think 40 years ago, when I was a kid, we didn't even have color television sets. And look what we have now. I mean, with flat screen TVs, you know, the side that, you know, in baseball fields, they can be, you know, 100 feet wide. I mean, it's just incredible to think of where we've come in all these other disciplines. And how do we get there? We do a formal mathematical analysis of something that we've developed that's new. If it works, it's borne out by the mathematics, and it's embraced formally by everybody who works in that discipline, in that scientific discipline. If it doesn't work, then it's universally discarded by everyone in that scientific discipline. If a medicine is shown in a double-blind, placebo-controlled study to be ineffective, you're not going to have one person offering it to you on the internet. And let's forget, you know, the laws, things like that. This is what's going on now in day trading and swing trading. There is no formal testing. So price action, price patterns, Fibonacci, and a few other things I'm going to talk about, which were traded 40 years ago, are still being traded today. And the failure rate in this field has not improved. And it's not going to improve as long as these are the basic fundamental methodologies that you embrace to trade. And this is the reason that so many traders bust out of the market. Now, right now, instead of academicians and scientists being in control of this field, it's in the hands of marketers. I mean, what you're sold on YouTube, Facebook, and it's all some variation of what I'm talking about here. Price action, price patterns, Fibonacci, and a few other things, because that's all they can think of. And they don't really care whether you make money or not. And all they want to do is make it attractive to you, sell it to you, and then go hide under a rock. They don't ever trade it live in front of you, and they don't try to make money with it. They just told you they've made millions with it, but you haven't seen them make it. So let's quickly move to price action. Now, Japanese rice traders created price action 400 years ago. And what did they base it on? Now, essentially, we can look at it this way. You have 100 kilos of rice, and you have 50 buyers and you have 50 sellers. You have to make an assumption that the Japanese rice traders made, and that is that the power of each individual buyer is equal to the power of each individual seller. Now, with that underlying premise, which must be operational in order for Japanese candlestick patterns to work, the patterns they created will tell you at any given moment who's in control of the transaction. Do the buyers have more power, or do the sellers have more power? So is the rice going to be purchased, or is the rice going to be sold? Not owned by anyone who's trying to buy or sell it. But essentially that's what we're looking at. But let's take an example of what happens, what could happen. You have 50 buyers, and then one buyer comes in who's so rich and has so much money, and he offers such an advantageous price that he controls the market and he dominates the market. And his big money makes all the other buyers' sentiment irrelevant. What's going to happen? He's going to walk away with the rice. And all the sentiment that we see traced out by Japanese candlestick patterns becomes irrelevant. When he steps up to the table with his wallet that's loaded with money and he makes the offer that he does, the transaction's closed and he's walking away with the rice. And all the other small retail traders are finished. Same is true on the sell side. If their traders try to sell and one person steps up who's got so much money, he's willing to offer a price on that rice that's so low, the trade's gonna work it in his direction. They're gonna buy it at the price he sets, and that rice is gonna sell at whatever lowball price he offers. And the reason he's able to do it is because he's got a ton of money and he wants that rice sold. So Japanese candlestick patterns work great in a transactional environment where the power of every buyer is approximately equal to the power of every seller. But if some entity, whether it be an institution or a trader, steps up to the plate that's got so much money that they can leverage the transaction in the direction that they want to go, then pure price action based on Japanese candlestick patterns become completely irrelevant. And that's the market that we're trading today. The Forex markets especially are dominated by big banks. I mean, the Fed, almost every country has a central bank. And that central bank sets an interest rate. And those big institutions working off the interest rate and the government set rate, Fed rate, if you want to say, in the United States, they are the ones that are going to control these transactions. The big banks like HSBC, Bank of America, even 401ks, mutual funds, hedge funds, they all deal in currency pairs. They are going to control the transaction, not you or I as small retail traders. And if we trade pure price action, we're going to constantly get run over by these big traders. Now, the same thing happens if you trade price formations. Now, the anticipation here, you have sequential lower highs, equal lows, is that you're going to get a bearish trend continuation pattern. Now, this falling triangle is created by retail traders like you and I. That's our sentiment. So some of these patterns are going to work, but a lot of these patterns are going to fail because if a big buyer steps in and that buyer wants to take that Forex market to the upside, this falling pattern is rendered irrelevant. And that's why traders who trade price patterns and price action bust out of the market 95 to 98% of the time. Now, there's another problem with the falling triangle and rising triangle and every triangle pattern. You can't make a risk assessment of the pattern. You have to make an a priori assumption that every falling triangle is equal power. And that's just not the way you can trade. You can't make an assumption that every falling triangle has the same predictive power, but yet there's no way intrinsic to the formation itself that allows you to make a risk assessment. And since you can't do that, you just can't trade this profitably. Now, here's what happens often, very often. You have the falling triangle and price just shoots out through the top because some big institution, some big bank, it doesn't make any difference what it is. They send that Forex market skyrocketing. And you and I as retail traders are going to get run over if we don't follow in the footsteps of big money that creates this trend. Now, it would be redundant to say the same thing with a rising triangle, but it's exactly the same. Sequential higher lows equal highs. Anticipation is a bullish breakout and a move to the upside. But you know that with the big banks and big institutions just waiting to move in, and let me tell you, one of the things that they enjoy the most is running the stops of us, of running the stops of small retail traders. Now, there are tens of thousands of small retail traders. And the more they can trap in the counter trend direction and run over as the move evolves, the happier they are. And you know how people always say, you know what? It's like the market has it out for me. I go long and the market goes short. Well, it's not an accident, because in actuality, that's what these big institutions are looking for. They're looking to trap a significant amount of retail traders in the wrong direction. So sometimes, there's an old saying, sometimes when you think that people are out to get you, they are. Well, the fact that you're not paranoid. Well, the fact of the matter is these big institutions are out to get you. And that's why you can't trade these patterns, and they are useless. And the validity of what I'm saying is simply borne out by the math. 95 to 98% of day traders went broke 40 years ago trading them, and 95 to 98% of day traders and swing traders go broke trading them today. Now, here's what happens. You get the breakout on a rising triangle. Institutional money just pushes this financial instrument to the downside. And I'm just going to use institutional money to represent whether it comes from a bank, a central government, some entity that wields an enormous amount of money. It's all that matters to us, that we as small retail traders must follow them. We don't create these trends. We have to follow in the footsteps of these trends. Now, I wanted to mention really briefly the J-hook pattern, because I had so many people, so many traders out there selling it to you, screaming that they've made 15, 20, $30 million trading it. And it's a bunch of baloney. And I'm going to show you why. And this could be any Forex pair that's taken a real shellacking, or it's gone up a significant amount. Now, what you're doing here is you're calling a bottom or you're calling a top. And I want you to take home, whether you come aboard or not. I hope you do, but if you decide not to, you cannot call a top or a bottom in today's market. You never know when the big institutional guys are done with the market. So what happens is, let's say this is the dollar yen, and the dollar is falling apart. Inflation is rampant. We're printing money like crazy. The Fed rate's at 0. The value of the dollar is collapsing. And for some reason, the Japanese yen is really becoming very powerful. So the euro yen, the dollar yen is going to take a real pounding. Maybe it'll fall to multi-week, multi-month, or maybe even multi-year lows. And then based on Japanese candlestick formations, we're going to see this hook. It's called the J hook or the fish hook pattern. And the bulls are going to come in and anticipate that what's going to be created is called a bull flag pattern. It's the hook. It comes up and consolidates, moves up and consolidates, moves up and consolidates, and moves up and consolidates. That's their anticipation. They're looking for the big money and calling a bottom. But it's really unfortunate, but they get run over very often. And if anyone tells you they made 15 million or 20 million trading this pattern, just shut them off. because they're lying to you. Because what the big money guys are looking for is for us as small retail traders to come in and call a bottom. And what do they create? Everyone knows what a bull trap is. They create a bull trap. Just like on a topping pattern, they create a bear trap. They get everyone going short, and then they push the financial market higher. Here, they wait for the small retail trader to come in, take this Forex market up, and they're not done with it. And they drive it further to the downside. And like I said, they love to run your stops. They're going to take all your money, and you're going to really get beaten up on the trade. Now, some of these will work and some of them won't. The majority of them will not work. And even if 50% of them work, the 50% that fail, remember, if this is a multi-month low, your next area of support is nosebleed down. You're going to take an enormous shellacking on this trade before you hit your first reasonable level of support to take you out of the trade. So you just can't trade this. And don't ever trade a bottoming pattern or a topping pattern, because there's no mathematical way of calling a bottom or a top in today's market. And believe me, I've been trading for 10 years straight, sitting in front of a computer every day. And I've done everything I can. And I've come to the conclusion and seen that there's no mathematical way to call a bottom or a top. Double tops at resistance, double bottoms at support. You know, they have these M and W patterns. They're not going to work for you, because the small retail trader is not in control of the market. And we create all these wacky shapes and configurations that these guys are selling us on the internet. Now, the last one I wanted to show you, you know it's not going to work. It's a topping pattern. The reason I wanted to show it to you really quickly is it's been copyrighted. It's the only copyrighted candlestick pattern I've ever seen. And I go into a lot of other traders' webinars because I want to see what they're talking about, what they're offering. As soon as I heard it was a topping pattern, I knew it didn't work. And I knew the person who's selling it, telling me he made $15 million trading it, was full of baloney. And what he's doing is he is telling us that bulls try to create an up candle and they fail. They create this long upper wick or upper shadow. The candle winds up closing to the downside, and what you get here is you get a hammer. Then you get then you get strong bearish follow through. You're in one tick below the close of this candle, and this heralds a nice bearish continuation pattern. Now, I'm always very respectful to other people and other, who are offering systems. It's not for me to point out that I think they're a bunch of junk. It's for you to do due diligence. So the only question I asked was, what was the predictive value, the positive predictive value of the entry, i.e. what percentage of these entries work and what percentage of these entries fail? Because just like all the other patterns we saw, we have to take it on faith that almost every one of these trades is going to work, because there's no way to make a risk assessment. If this is a formation on the euro pound versus a formation on the dollar kiwi, we have to assume these are all going to evolve identically. And you just can't do that. You can't trade a system where you have to assume that the entry of every pattern has the same power. So what I did was I just looked at the market myself. I looked at a bottoming pattern. Bears tried to close the candle to the downside, bulls close it to the upside. It's not quite as elegant a hanging man as I would like, but that's essentially what it is. Get strong bullish follow through, you're in one tick above the close, and then you get a nice bullish move. But then the big money comes in, and what they're looking to do is run our stops. They've trapped a lot of us in the wrong direction, and they're going to have a nice field day as they push this Forex pair right back to the downside and run us over. So you cannot trade these things. And if you try to do it, you're going to lose your account. And no single price pattern has any more power than any other. If a rising triangle doesn't work, they all don't work. Falling triangles, the same thing with channels. Channels are created by small retail traders. If we have a rising channel, our anticipation is we're going to break out of the channel to the upside, retest support, and move to the upside. But when big institutional money comes in, that channel's all useless. Now, I just want to touch briefly, like I don't want to go launch right into my software, because if I did, I want to make this educational. And I want you to come away with things and learn things so that even if you don't come aboard, and like I said, I hope you do, at least at the end of the hour, you will, I believe, learn really solid foundational concepts that will help you trade into the future, help you trade in the future, no matter what system you use. Now, Fibonacci quickly was a 13th century mathematician. He's alive, I think, in around the year 1205. And he created Fibonacci transformations, which give us Fibonacci numbers. These numbers describe really interesting symmetries in nature. The most common ones that are quoted are the number of edges on a snowflake are always a fib number. The number of ridges on a pine cone, always a fib number. And if you put Fibonacci into YouTube, you'll find some amazingly creative ways of manipulating Fibonacci numbers. But here's what we're asked to do. And this is, I consider to be what's called magical thinking, because there's no mathematical basis for this whatsoever. And that is to take Fibonacci extensions or retracements, and most people use Fibonacci retracements. And here's the 61.8% retracement. And assume magically that this is going to act as an area of resistance as price rises to the upside. Now, why would there be sellers at this line? I mean, if you could tell me that, I'll give you a nickel, because there's no reason for it. We're not studying price in the markets. We're using a 600-year-old formula to create these areas of retracement, which we're told adequately and with great precision describes market sentiment. It's impossible for that to be true. And again, this is what's called magical thinking. And if I could be able to give you a figure as to how many people went broke trading Fibonacci off the right edge of a chart, you'd probably be dumbfounded. And it's constantly being offered because it's constantly attracts traders. Why? Because they're told it works. Does anyone go to the point of proving it works? No, because if you take a year of backtesting and you look at Fibonacci levels, whether they're retracements or extensions, you're going to find that they break or hold totally at random. And they're useless to trade off the right edge of the chart. Now, I want to quickly expand on that to include Elliott and Gann. Now, at least Elliott and Gann, to their credit, looked at price action and price movement in the market and tried to create formulas that describe market sentiment adequately. So at least let's take our hats off to them. They were looking at price movement in the markets. They saw what they thought were recurrent patterns. They created formulas to describe these recurrent patterns and try to help us trade. The same with Gann and the same with Elliott. The problem is they did it before big institutional money ran the market. Now, back in the day, maybe it worked 40 or 50 years ago, but today, forget it. If you try to trade it, and traders have been trying to use Elliott wave and Gann theory, and somebody out there combined them to create Gann Fibbo something or other. So you take two broken systems, add them together, and you get a doubly broken system. The bottom line is that these are not going to predict how price is going to move off the right edge of the chart when big money steps in, and that's the only time you want to trade. When you and I as small retail traders are in control of the market, it's going to chop. Now, I also just want to add in divergence. Divergence is a signal. George Lane was the first guy to create an oscillator. He did it in 1963. He was a brilliant mathematician, really. Whoops, I got an Amber Alert on my phone. I'm sorry. Let me mute it. Somebody's missing. 16-year-old. It's a real. Sure, that's a shame. And made me lose my train of thought here. And when George Lane created divergence and created the oscillator, he created stochastic. I wouldn't be surprised if an enormous number of divergence signals worked, but not today, because divergence is just another way of trapping us as small retail traders in a position to be caught in a bull or bear trap. We cannot call a top or a bottom. So if price action, price patterns, Fibonacci, Elliott wave, Gann, divergence are going to fail way over 50% of the time, what's the only thing that's going to work? And it's going to be following the direction of institutional money. It comprises over 70% of all the volume of every Forex market. And institutional money is uniquely positioned to control the Forex markets in their totality. They really heavily leverage their big bucks on these currency pairs. So you have to follow them. And this hand I put in here to show that when they grab a candlestick, if they want to lift it up, you got to go long. If they're going to push it down, you got to go short. And you need software that's going to track what they're going to do, to try to give you the heads up and a leg up, forgetting about all the other stuff that you just saw. And remember, everyone out there has been trading it for decades and not making any money, except the guys who are trying to sell it to you on Facebook. So following the direction of big money, I personally believe, excuse me, in my humble opinion, is the only way to trade. Now, just to recap quickly, if the market consists of all small retail traders trading one lot, two lots, three lots, all with equal power, everything I just mentioned to you is going to be effective. We are going to get good market sentiment off of rising and falling triangles and Japanese candlestick patterns, but those markets are gone forever. And here's the market now. There's that big guy. And like I said, it could be a big bank. It could be a big institution. I mean, it could be Goldman Sachs. It could be JP Morgan. It doesn't really matter at the end of the day. It could be an overseas bank. There are a million huge banks overseas that leverage an enormous amount of money. HSBC, I mean, I can't even think of the names of all of them. Our sentiment in the market is irrelevant. Only the sentiment of this guy is important. And as time moves and time progresses, year after year after year, this purple marble is going to get bigger. And we as small retail traders trading a few lots are going to become more and more inconsequential in determining the direction of price in any currency pair. These are the guys that are going to control and rule the markets. Now, you have to decide there's an enemy in the market and there's an ally. So if you don't create appropriately and define in your head who your enemy is and who your ally is, you will not make money. You have to ally with all big money. Since you can't beat them, you know, it's the old saying, you can't beat them, you got to join them. Well, you can never counter trend trade against their direction. So they have to be your ally. So who is your enemy? Every other small retail trader. You go home at the end of the day with a thicker wallet. The money's come from the other small retail traders. It has not come from these big institutional guys. You're never going to take a penny from them. You're going to take your money from the other small retail guys. They are the enemy, and that is a mandatory ally. Now, we calculate money flow because the big institutions and banks rotate their money from sector to sector. Now, not only do they do it from currency pair to currency pair, but they do it from currencies to other markets. There may be certain times when trading, when putting your money into currencies is very advantageous. There may be other times when it's not advantageous, and it's just called sector rotation. There may be some times when big money is going to be going into stocks. Other times it's going to be going into bonds and notes. Other times it's going to be going into currency pairs. And then within each market, the big institutional guys are going to decide which of the currency pairs they're going to take control of and move to the upside or move to the downside. And what we do is we track this sector rotation using our proprietary technology. Now I want to show you a trade. It's on the futures market, but it doesn't make any difference what market's on. Now, everything on the chart here has significance. The green background, these three green lines. I'm offering you a system today that's one step more sophisticated than what you're seeing here. So you're not going to get this oscillator. But the candle halo, the pivot.
Order filled.
Now you're trading in the direction of big money. And remember, a pivot has a bunch of sellers in it because they turn the market here. Now this is using Unorenko bars. Now I don't trade Unorenko on Forex, as I'm going to show you. I trade time bars. But I'm using this to illustrate a point, and the point is relevant irrespective of the kind of candle you trade.
Target filled. Target filled.
Now we had a gold trade today that gave us a full winner in like less than a second. Now you know that win wasn't created by retail traders. It was created by big money. I mean, they shot gold down so fast that my trader couldn't even yell out first target, second target, trade closed fast enough. That's what happens when you trade in the direction of big money. Now, how much money made on the trade is irrelevant. If you trade one lot, 5 lots, or 10 lots, is irrelevant too, actually. It's all based on how much money you have in your account. What's relevant is the predictive value of the entry. And here you can make a risk assessment. If you don't have these 3 green lines, I'm going to tell you what they are. It's riskier. You don't have green background, it's riskier. You don't have the blue candle halo, it's riskier. You don't break the pivot, it's riskier. If the 50 isn't heading up, it's riskier. If this 15 EMA of an EMA isn't heading up, it's riskier. So all the independent variables that are present on the chart, if they're not there, when you take a trade, you start to assume risk. So you can make a risk assessment of every entry when you hit your mouse and take a trade. That's extremely important. So we use 3 key metrics that determine money flow. I don't want to go through these pretty quickly. It's a lot of information, and if you come aboard, I'm going to do a master class. I'm going to do it next week. There's a lot of Forex traders already who want that Forex master class. And what I'm going to give you is a Forex, you're going to see part of this is I'm going to give you a Forex master class. I just did. I'm going to do another one, and it's a 2.5-hour master class. I mean, you're going to learn everything that you ever wanted to know about trading Forex and then some. What to do, what not to do, and how to trade it. Now, there are 3 things we look at. One are the correlative markets, and it makes the assumption that no Forex pair moves in isolation, that every Forex pair in one way or another is linked to every other currency pair, and no currency pair moves in isolation. Although some are very tightly correlated, which is the ones we leverage, the ones that are loosely correlated we don't bother with. But that's the bottom line of artificial intelligence. You have to make the assumption that if the the dollar yen is heading up, it's not heading up in isolation to every other currency pair out there. Everything reverberates on everything else. The second is the multi-time frame assessment of Laguerre momentum, and the third is the multi-time frame assessment of order flow. And order flow can be assessed on the Forex markets, even though the order processing component is not centralized. Now, the first thing we're going to do is we're going to look at order flow. And here's why we can calculate it. And the indicator does the calculations for you. And that's what makes it so helpful. You don't need an order flow indicator on your charts. Now, on every candle, you're going to get a market delta. And at every pip level on the dome, you have buyers and sellers. Somebody who wants to sell a pair and somebody who wants to buy it. And what this market delta number is going to tell you is on the dome, is there an overabundance of buyers or an overabundance of sellers? Now, the market delta number, if it's green, it tells you there are more buyers, there's buying pressure, and therefore the candle should close up. Now, nomenclature, quickly, this is called the volume ladder. Inside here are stack sellers and stack buyers. This has no real power at all. We look at the market delta. Now, here's a positive delta on a down candle. So if you can get a positive delta on a down candle, you know you got yourself a problem. Now, here is something else that I want you to take home. And no matter what you do, please incorporate this as part of your trading methodology. Because I spent 8 years studying applied mathematics, and I'm telling you that this is true. That no indicator that assesses data from your trading chart is ever going to have any forward-looking ability. Everyone always moans and groans about lagging indicators, but but the vast majority of traders still use them. You can't use any assessment that is created from data on your trading chart. But the problem with market delta is even more difficult than that. This positive delta on a down candle is telling us something, and that is that this doesn't give us all the information we need. And the reason we have a down candle here is because it tells us that the sellers are more aggressive than the buyers. The sellers are willing to unload this currency pair appreciably below its ask. And so with that aggressiveness, they're going to overdrive the fact that there are more buyers. So we have to find a way to overcome that Now, these kinds of candles are going to occur far less than one standard deviations worth of data time. So here's how we do it. What we do is our trading methodology and our indicator analysis is based on the way that a system that Alexander Elder developed. He wrote a book called Trading for a Living. I read it in 1997. I think he wrote it in 1995. It just was republished, and you can get it on Amazon. It's called Trading for a Living by Alexander Elder. Now, this was a guy who, trading stocks, made millions and millions of dollars in a time when day trading and swing trading used very primitive indicators. But he did it the right way, and he did it via a method that he developed. And he called it the triple screen method of assessment. And what he did was, this very smart guy, he realized that you can't use any data from your trading chart. So he looked at the two higher multiple charts to create a derivation to determine what's going to happen on your trading chart. So let's say you're trading a 2-minute. Alexander Elder looked at the he took the 2-minute, multiplied it by 3, looked at the 6-minute, looked at the 6-minute, multiplied it by 3, and looked at the 18-minute. So it's the 6-minute and the 18-minute where we look at for the market deltas. If you're trading range, we do use Fibonacci symmetry. So if you're trading a 5 range, we're going to look at the 8 range and the 13 range. If you're trading a 377 tick, we're going to look at the 610 tick, and I think it's the 987 tick, the two higher fib numbers. But we never look at our trading chart to give us any information about how price is going to move off the right edge of the chart. Now, because we get an occasional outlier where the delta value does not predict the direction that the candle is going to close, we put those market delta values into a 15-period SMA. So what determines who's in control of the market, the bears or the bulls, is determined by the average market delta value looking at the last 15 values. And they create a slope of this SMA. If you're trading a 2-minute, a 6-minute slope, and an 18-minute slope. And when both 15-period SMAs are sloping up, big money's at work, there's tremendous buying pressure in the market, and you must trade long. When both 15-period SMAs are sloping down, the bears are firmly in control of the market, and you must trade to the short side. Now, when both 15-period SMAs are not in agreement, who's in control of the market? Us. You and I as the small retail trader. All we can do is create chop. We can't create a this isn't a tie. I always fall into the trap of calling this a higher multiple time frame chart, but we can't create higher multiple alignments of any of these assessments. We don't have the power to do it. We have the power to manipulate our trading chart, but not the two higher multiple charts. So here's that SMA on the two higher multiples, and they're both heading down. So we know that, but based on order flow, institutions have created a tremendous amount of selling pressure. Right here is where you have to go short. And if you look at the line here, that's one of those, remember you saw those 3 green lines on the trade? Well, here's that green line. And here's the currency pair. Now I put it on a Unirenko. I don't recommend trading Unirenko. You can though, and we have traders who do it. They scalp 5 pips, boom, 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 boom. And I'm not a scalper, but they trade a 10 Unirenko and they scalp 5 pips reliably with big lots. They trade between 5 and 10 lots. Just had a guy in the room today talk to me about how much money he's making in Forex, trading a large number of lots on a 10-unit Renko. But I still recommend trading time. Now, what are these traders here doing? They're calling a top. Does it matter the time frame? It doesn't matter whether this is actually a unit Renko, so it's not time based. It's all irrelevant though. The fact of the matter is, as long as order flow is aligned to the upside, they're calling a top is what we hope they do. Because what we're going to do is we're going to take the next up pivot and run them over. The next up pivot and run them over. Now we have an ATM that allows us to stay in the trade for the entire move. So we're just going to let these retail traders have their fun for about 5 minutes or so, and then we're going to use them to help propel the trade to the upside. Because as they have to start buying their lots back, they're going to help push this trade to the upside. These are the traders that we're going to take money from every day, almost every day. And every time there's a wick, and in this whole move up, there's internal wicks. There's always sellers here trying to counter trend the direction, counter trend trade the direction of big money. Now, the second is gear momentum. What is momentum? Why is it important? And what does it measure? First of all, momentum measures price acceleration and price deceleration. And what the heck is acceleration, deceleration on a chart, on a trading chart? It is simply the close of the candle approaching the low. As the close squeezes tighter to the low, tighter and tighter to the low, we call that price acceleration to the downside. I mean, that's standard nomenclature when we talk about an oscillator or momentum in the market. And everybody talks about momentum. What they're talking about is price acceleration to the downside or to the upside. Excuse me for 1 second. Okay, so that was just my son. So that's what we're looking for. We're looking for price acceleration. But remember, the acceleration to the downside or to the upside of our trading chart is not predictive off of what's going to happen on the right edge. We have to look at the two higher multiple charts. Now, I just want to say one other thing. We use the Laguerre oscillator because it's the only one, it's the latest oscillator added to all the other oscillators. There's stochastic, there's the Arun oscillator, there's Williams R, there's RSI, there's ADR, ADX. These were all created to look for divergence. That's their #1 goal. But you and I both know that we're not top calling and bottom calling anymore. We are trading with price acceleration, and we're not going to look for a top and a bottom. The other indicators are looking for tops and bottoms. That's their #1 goal. When George Lane created the formula, he was looking for divergence. And one thing that Alexander Elder tells you is if you're going to use an indicator, open it up and look at the formula. Get an idea of what it's trying to do. Now, just as a quick aside, oscillators don't work on Renko because you need an open high-low close of every formation. You need a wick, and Renko has no wick. I've seen $15,000 platforms trading Renko bars off an oscillator, and that %K line is absolutely bogus because it doesn't have enough data to create it. But we look at the two higher multiple charts. We already know what they are. I'm not going to be redundant. So we look at the momentum lines. If they're both sloping up on the two higher multiple charts, we know the bulls are in control. If they're both sloping down, we know the bears are in control. And if we know they're not in agreement, we know we're in control, and we desperately don't want to trade. And another takeaway message from this webinar, which is really important for you, is your number one goal in day trading or swing trading is not to get winners. It's to avoid losers. And if you use that mentality, that's what's going to make you money. Every trader that started with a $100,000 account and drove it to zero got 1 million winners. What they could not avoid was the huge number of losers that went along with those winners. So what you have to do is learn to sidestep almost every loser. That's what's going to make you a professional, profitable trader. And that's what the software seeks to do, to show you when chop is around and when to take your hand off the mouse, and to show you when big money has created a trend that you want to get in on. So now there's the 2% K lines, both heading up. Momentum is heading up. Price is accelerating to the upside, which means that buying pressure is intensifying. We have to trade long, or we're very likely to get stopped out. Not going to get stopped out 100% of the time because nothing is perfect. But we're endeavoring to be perfect, but we will achieve that in an infinite amount of time. But don't try to counter trend trade this multi-chart assessment of momentum. Let's put them together. So here's dual reds. We take the first down pivot. Dual greens. We take the first up pivot. The predictive value of this entry at minimum is 75%. With a few more things thrown in and a lot of some patience and discipline, you can push this to 85% or higher. And you can make a very clear-cut risk assessment on every single entry you make. Now, the quant line is our neural net. And I didn't bother to make a Forex neural net. I just used the one that we use on the E-mini because all I want to do is show you the principle. And what the chart's labeled is really irrelevant. Now, this could very well be a currency pair. It does not matter. And here's our quant line. It's red and it's green. We already know there's no way that we're looking at anything on the trading chart. And we already know, and this doesn't have to be the E-mini, like I said, it's going to be a currency pair. And we need a unique quant line for each Forex pair. So it's a lot of work for us to create this suite, because what this line does, it looks at the tightly correlated Forex pairs that tend to move in the same direction or counter trend direction as the pair you're trading at least 70% of the time. So if we use the E-mini analogy, if we want to trade the E-mini short or a Forex pair short, we need its tight correlative markets, which in this case are the Dow, the Russell, and the NASDAQ, to be heading down using that triple screen assessment. That creates this red line. And how likely is it, if this is a Forex pair, if its tightly correlated markets are also heading down on a triple screen assessment, that we're going to get caught in the wrong direction? Very rare. Now we've got them both, all three, in the up direction. Every quant line analyzes 3 correlative markets, in this case 3 correlative Forex pairs. Now, the reason we call them quant lines is each of those 3 Forex pairs will not have the same correlation coefficient. One of them may correlate 0.9% of the time. 90% of the time, it's going to move in tandem. Another may correlate 80% of the time. They must correlate 70% of the time, or we can't use it. And a Forex pair that moves in the counter trend direction 90% of the time is just as powerful as a Forex pair that trades in the same direction because it has huge predictive power. But we take the correlation coefficient and quantitatively weight them in these lines. Each individual currency pair has its own quant line because every currency pair has a unique 3 correlative markets, which we have busted our case over to determine. So here's the system in a nutshell. There's a couple of more quick things I need to add, and we're there. When we don't have green, 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 red, 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 we know who's in control of the market, us, and we don't trade. When we have green, 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 we know we have to trade long. Now, if you're knocked out of the trade by this retail trade, by these retail traders, just go right back in on the up and run them over and take their money. Punish them for knocking you out of the trade. You still have a lucrative move up. They limited your profit, so now you're going to take their money and go up higher. Now, I automated this slide because it's just really sort of the core methodology of what we do. Using that triple screen method of assessment, we not only look at multiple time frames or multiple chart set, the triple screen method, it doesn't have to be a time frame. And again, I always fall into that trap. We look at multiple Forex pairs on the triple screen method. So this chart assimilates a lot of data. And in this long move down, you always have traders calling a bottom. There's a bottom caller, there's a bottom caller, there's retail bottom caller. And all we're going to do is run them over and take their money. These are the traders that are going to fatten our wallet. Now, every trader that creates an up wick, and on the platform, you can see these up wicks. These are the traders we're going to run over and take their money from. These are the traders the institutional guys are trying to run over. By trading along with them, we're going to run them over too. Now, a small retail trader can create a retracement. Now, when we're green, 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 we can only trade long. When we're red, 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 we can only trade short. We're going to let the small retail trader have their say, try to retrace price back to mean. That's a powerful force where price always wants to move back to mean price. And that's what they're trying to leverage. But you can't call a bottom when institutional money is still at work. Let them create their candles. We're going to take the first down, run them over. Retail traders, we go down, run them over. Retail traders, down, run them over. And again, they're present in every single candle. They're trading Elliott wave, MACD, price patterns, channels, Japanese candlesticks, the whole smorgasbord of stuff that I talked to you about that does not work. They're trading something. They're not doing this because they've got an itch they got to scratch. They're doing it because their trade methodology is calling a bottom, and we are going to use their mistake to profit. Now, the other thing that's important is we want to roll everything in our direction. Is we want the currency pair that we're trading to also be in a triple screen alignment. If we're going to trade the, I think I always say the euro yen, we want the euro long, we want the euro yen on a triple screen assessment to be long. Now, it's almost always going to be long if we get those 3 metrics below green, 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 but occasionally it's not. If we want to trade it short, we want the euro yen to be in a triple screen assessment aligned to the downside. Now, there's 3 different down colors and 3 different up. None of this assessment is made by looking at price movement on your trading chart. We're using the triple screen method, which as far as I know, is the only accurate way to create an indicator analysis that has future predictive value. So when background is green, or I'm sorry, is pink, this currency pair, and it doesn't matter whether these are minute, 15-minute, daily, weekly, monthly, it's irrelevant. As long as that triple screen assessment of this financial instrument, this currency pair, is aligned to the downside really powerfully to give dark pink, it's going to meander down. We're not getting an entry here. We're simply getting a directional bias. We're not ever going to take a long trade on a pink background. And here's the long trade. And we're going through 3 different powers of up on that triple screen assessment. Cyan is intermediate, dark green is the strongest, and light blue is the weakest. But they're still all triple screen assessments of alignment of this currency pair to the upside. And we'd like to have that 15 EMA heading up. And this is a 15 EMA of a 15 EMA. It's a really unique line that we created ourselves. And we'd like to see that aligned to the upside as well. This decreases risk, and we can make a risk assessment on the trade. The last thing we have to look at are pivots, which are areas, obviously areas of support and resistance. Now, there are 2 different kinds of areas of support. Now, first of all, almost every pivot that I've ever seen in another platform, either they ignore pivots, or if they do trace them out, they create them wrong. A pivot is created off a candle body low, not a wick. Wicks were considered by the Japanese to be fluff, irrelevant, and not to have any validity in the way we trade. So the pivot has to be traced off the candle body low, the way our software does it. And the break of a pivot is based upon a 2/3 cross of the pivot by the candle body. Not a third, not a half, but 2/3. That's what the Japanese rules, Japanese candlestick rules call for. And that's what the pivot does. So if you want to take a trade on a break of a pivot, which is very advantageous, if you're taking a long trade and breaking a short pivot, you're going to be stopping out all the sellers in that pivot. You got to wait for 2/3 of the candle to close above the pivot to snap it and start leveraging all the sellers sitting in that pivot. Now, the other thing that we look at is volume at price. Now, I don't know, 3 years or 3.5 years ago, there was a craze about market profile. Now, market profile can be used on the Forex markets because there is a dome, and it does you do get a point of control. You do get a value area high, a value area low. Now, I looked at it mathematically, and you could tell that it was a piece of junk, and we never traded it, even though we made one. But it was an enormous fad, and everyone had to buy one, and everyone who traded it went broke. And you can see it's gone now. It's like, in fact, I always pointed out as the only indicator that's come and disappeared. I mean, I think it was busted so many people out that even the phony marketers had to stop selling it because nobody wants any part of it anymore. But boy, oh boy, was there a craze for it. But it does create one relevant assessment, and that is volume at price. There is going to be a pip value where there's a significant amount of volume crossed, and that's based on the dome. It's not executed buys or sells, and because the execution process isn't centralized, it is not the total aggregate number of traders at any given pip value, but it still has validity. So on a triple screen assessment, if there's a specific pip level or price level that's accumulated an enormous amount of volume, a ton of traders have traded it at that price level, then, and they align on the two higher multiple charts, we create this zone. And this is a very strong area of support or resistance because traders in these zones defend this price. So if we trade down into it, it's often rejected, often rejected, often rejected. And our goal is to avoid risk. Now, sometimes price walks right through it, but because we can't tell when it's going to break or when it's going to hold, and our whole methodology is about making a risk assessment, we have to stand aside on every unbroken zone or every unbroken pivot. It costs us some winners, but it saves us from taking a ton of losers. And that's what day trading and swing trading is all about. And here's to the upside. Down, up, down, up, down. Now, the revolutions entry, which is a part of this platform, is the most sophisticated entry signal I wrote ever developed, but I really don't want to be too histrionic. And let me just say it's the most sophisticated entry signal I've ever seen. Because what it does is, and you should see its inputs. It's got about 75 inputs. And some of them are modifiable, and we're going to give you templates for every Forex pair. What it does is it tells you when all the things I discussed are in perfect alignment, so you don't even have to think about it. It's sort of handing you a trade. And we call it our cerebral cortex trading system because about 30 of the inputs are external to the locked-in coding that you can't see. And the reason that's true is because, in a sense, it could be taken as a strategy and an automated entry. We want it to have that kind of precision when you see it. And it can't work in every market. And it can't work in every market unless it's modified. A high volume, high volatility market needs different settings than a low volume, low volatility market. This is why strategies in automated trading, for the most part, 99% of them fail. They're based off a fixed algorithm, and they only trade a market that has one personality. Either the high volume, high volatility, low volume, low volatility, or they take an intermediate stance, in which case the predictive value of the entry is mezza in both sets of circumstances. For us, we can simply give you a different template and change the way the signal is taken. So here's all the external inputs right here. It's 3 different JPEGs. Now we give this all to you. You don't have to put them in. For all the Forex pairs you trade, we're going to give you this template. It's going to be embedded in the platform already. But when the Forex markets change complexion, we're going to change these inputs. So it's easier than you think when you put it all together. You get an exact entry, an exact exit, and the targets are all pre-configured. Now here's a 2-minute trade. Now there's your perfect revolutions, we call it, signal entry on this is the Aussie dollar. It's a 25 pip move, and it's a 5-minute chart. You can see the triple screen is looking at the 15-minute, the 3, 5 times 3, and then automatically defaults to the 45-minute. Now, here are the correlative Forex pairs. Here is that triple screen assessment of momentum, And here's that triple screen assessment of order flow. Here's that triple screen assessment of the direction of the Aussie dollar. The 50 is down. The 15 is down. This line I didn't discuss because I'll do that in the master class. It's a really complex line. And I just wanted to hold off. Now, the candle halo is also just telling us order flow. It's telling us what this bottom line is. So there's your perfect entry. You don't even have to fish for it. And you're going to see that you're going to get a scanner that's going to flash this entry for you. This is a 25 pip move. Here's the move on the euro pound on a 5 minute. There's no signal to exit except the changing candle halo. So you're in this trade all the way down, 28 pips. Here's 31 pips on a 5 minute. There's your entry. Now this is a software generated entry that you're going to see is going to come on a scanner. But you can see it's looking at everything. 50, 15, trend line, candle halo. These three lines. Orange is as good as red. Here's the signal. It waits for the pivot to break, takes the candle where the pivot is broken. You have three green lines, background is green. It's going to flash intra-candle. It's only a 13 pip move. But let me tell you that can be a very, very lucrative move if you trade 2 or 3 lots. That's a really nice move. You know, if you're looking for 5 or 6 pips on a 5 to 10 lot, it's a very lucrative move. Here's a 17 pip on the pound dollar. Now, I mean, I could just show you an infinite number of these. You're going to get these triangles all the time, and they're very smart triangles. They look and analyze all the data on the chart. Now, can you take a discretionary trade? After the master class, I'm going to show you that yes, you can. And I'll show you what I look for, where I might take a trade where I might not necessarily get a system generated entry, but it's going to be a very, very low risk trade anyway. This doesn't catch every great trade, but when it signals, it's a terrific trade. Here's the US Canadian 60 pips on a 15-minute chart. Huge move, perfect entry. And you could see it needs green background for the upside or pink to the downside for the entries. But you're not inextricably linked to this signal. This is sort of your leg up. Here's another trade, 61 pips right here on the dollar yen. 52 pips on a 15-minute of the dollar yen. Big time frame. Now we're going to skip this. Now I have a lot of testimonials, but I'm going to spare you them. I mean, we have a lot of traders who make money every day trading Forex, and we have so I mean, they're really heartwarming stories, and we have one from a man from the Miami Chamber of Commerce. We have one from a politician who's currently in office. They're not going to give us phony testimonials. These are real, but I'm just not going to put you through the agony of having to listen to somebody else's story. Take my word. I mean, these are really, really good. These are honest testimonials. Now, this is our cumulative profit for all our Forex pairs for the entire year from the 1st through August 4th. It's about $200,000, but we trade a fairly large number of lots. I do a risk assessment. If risk is exceedingly low, and there's a few other parameters that I didn't discuss with you that you'll see in the master class, I will weight that trade heavily, and maybe I'll trade it with 10 lots. And if I think a trade is a little riskier, maybe I'll pull back. You don't have to do that. You can take every trade with the same number of lots. That's up to you. But that's what's gotten us this much money. Now here's just one of the traders in our room on 7/7. He was just so happy. He made $3,372.50. Now, this is not me. I didn't do this. The trader's name is Hines. He's in the room almost every day. Made $3,300 in one day. And I just wanted to show you this is on 7/7. So, you know, it's the old cliche, because I'm really towards the end here. Trading success equals financial freedom. You have no pressure. You work from home. You have no boss. You have no commute. I'm sort of making a joke out of it because that's how everyone closes. It's like, you know, you drag yourself out of bed, wipe the sleep out of your eyes, trade for 34 seconds, make $100 million and go back to sleep. Well, it's not going to be that way. With discipline and patience and screen time, if you can make a considerable amount of money. And here is sort of my promise to you. This software works. The type of analysis that it does, that triple screen method, has tremendous future predictive value on your trading chart. It isn't fluff. I trade this software every day in front of 250 traders. So I don't sell it and hide under a rock. I sell it and I trade it. And it's extremely effective. What I ask you to bring to the table is patience and discipline. Don't overtrade. And we're going to give you a month in the trading room. I think we might have forgotten to put that in as an add-on, but you're going to spend a month with me in the room. So it takes away that solitary component to trading. Because if you're home and you're sitting there and you're all by yourself, you tend to get bored and maybe you're going to overtrade. And that is a deadly flaw. So by being in a community of like-minded traders, it's going to help you stay the course. Now, it's easy to learn. Now, I used to call these golden triangles because they're so powerful that when you see them, the predictive value is very high on getting a winner. And they take into account a lot of factors that I did not discuss in this webinar, simply to conserve time. Many more factors that you'll get in a master class. And Rory's going to give you a link to the last master class, which lasted 2.5 hours. And I go into a lot of that information. And it really is perfect for beginners. Now, you can really use it to trade any financial instrument, but the one that we're going to give you is the one that's uniquely formatted to trade Forex. And obviously, you can use any account size because you can trade one lot. Now, I like trading with beginners. They don't have to unlearn a lot of junk that they've been taught, and they haven't been financially scarred and having multiple accounts get busted out. And they haven't purchased lots of expensive software and training programs that haven't worked. They're kind of like they're just newborns, delivered into my arms, so to speak. And I'm going to put you on the right road right from the start. And you're not going to take that drawdown that most traders do and take that banging around than most traders do. Now, we're only selling a limited number of copies for a reason. That entry that you saw, the Revolution's entry, puts everyone in at the same hip level. And I don't want to create slippage. So if the system is of any interest to you at all, and cost is not, a problem, right now, don't think about the cost, because you're going to see how really inexpensive it is. But if you're interested, you want to lock in getting a system, just give us your name and your phone number. Rory will give you one call, ask if you have any questions. If you're not satisfied, we'll never contact you again. It's simply a way of locking in this discount price. It really is a discount price at no risk. Now, if you're out of country, we'd appreciate your Skype and not your home phone, not your cell phone number. We can get you on WhatsApp, but it's very, it's very tough to make a connection via WhatsApp. So we just appreciate your Skype. So there's no downside to doing it if you have any interest in the program. And Rory's our trading expert, and he'll answer any questions that you have. And he'll guarantee you a copy of the software at a discount price. Now, you're going to get this market analyzer. Now, we used to put it in as something that only the first few buyers got, but it just became so critical to trading that we just added it as part of the software package. Now, I have it set up for stocks, but you can put in as many currency pairs as you want here. And up here, you can put as many time frames as you want. You can put in a 1 minute, a 5 minute, a 15 minute, a 1 hour, a 4 hour, and you don't even have to put in time frames. You can put in range. You can put in Unirenko. You can put in tick. You can trade any kind of candle formation you want. I don't recommend Renko simply because of the fact that the oscillator is going to have a hard time with it. But all you're looking for is a green color on the speed of the chart you're trading. If you're trading Apple, or say you're trading the dollar Canadian on a 5 minute, you just look at the 5 minute buy. You don't have to get a 15 minute, a 1 hour, 4 hour. Just look for the buy on the time frame of relevance to you. And you pop that chart open, which I'll show you how to do in the master class. It's easy to fold up 12 Forex pairs. You pop it open, and you're very likely going to get a Revolution's entry, and you're in. So the only problem you may have is you get too many entries. Now, obviously, you can use it to day trade and swing trade. If you want to day trade, you're going to take the shorter time frame. If you want to swing trade, maybe you'll take a 1 hour or a 4 hour. If you're going to take a 4 hour or a 1 hour, be prepared to do a multi-day hold. It's likely that trade's going to evolve over 2 or 3 days. It may evolve over a week. So you're going to have to take a buy and a hold strategy. Now, the indicators only project on NinjaTrader 8, but a lot of other platforms will power NinjaTrader 8. Thinkorswim will, Alonda will, Interactive Brokers will, eSignal will. So you don't necessarily have to have Ninja 8 to use it. Now, the worst case scenario for you is your broker simply doesn't, and there's no data feed we can bring across, because these are data feeds that are created by your broker to power NinjaTrader 8. And we do a white glove installation for you. For $100, you can open up a NinjaTrader account. And it'll take you about 72 hours of paperwork, but you don't trade it. You take your signals off of it and you trade with you trade the platform and brokerage that you like. Now you get a rapid results quick start guide. If you're technically inclined, which I'm not, you can set this thing up yourself. most traders call us and Sergio will do the configuration for you. Now, if you happen to trade a Forex pair in which we don't have a quant, we'll build one for you. We have a huge library, so I would find that very unlikely, including all the Kiwi crosses and some of the less common. But a lot of traders like to trade the Kiwi crosses, I found. But we'll do the installation for you. You do not have to worry about that. You worry about trading and we'll worry about the tech. Now, what's really important here is you get free lifetime updates and upgrades. Like if we make the system better, you get that improvement for free. Like it's not our company philosophy that if we come up with a 2.0 version of the software, you're gonna pay us $500 or $600 for the upgrades and add-ons. I mean, I don't like that philosophy. You come aboard and you're gonna see this is a lifetime purchase also. I do not believe also in every year you're gonna get a recurrent charge. You purchase the software, it's a one-time purchase. That's it. You get the scanner, that's also a lifetime purchase. We're on everything. Now, the VIP support we give you really is valuable. I call a ton of other companies because I listen to their webinars. And if I have a question about trading, if I have a question about their methodology, I get voicemail or I get an answering service and I never get a call back. They don't want to spend their time with me. They don't look upon me as a potential buyer. And in fact, people who ask questions are the ones they don't want to deal with because, you know, I can punch holes in their system, they think, just by mistake, just by asking the wrong question. So I just don't get calls back. We're here all the time. There's 5 people here in the office and we don't live here, but we almost live here. So you're always going to get someone to help you with your trading. And if you really need a question asked, I'll help you myself. I'm here to support you. And the way I look at you guys and you ladies is you are our small community of retail traders. If you join us, it's us as a small community of retail traders that I want to shellac the tens of thousands of other retail traders out there who have no clue how to trade. And it isn't really that hard to do if you don't use the broken trade methodologies that all of them use. Why shouldn't we take home the bacon every day? We're not taking it home from the institutional guys. Let's trade with them and take it home from the other retail traders. Now, we also do coaching calls once a month. Now, everybody comes into the room. It doesn't matter what you trade, futures, Forex, or stocks. We have this enormous get together. There's hundreds of people in there, and we all talk about trade methodology. And remember, the core trade methodology, whether you trade futures, Forex, or stocks, is pretty much the same. We use the same triple screen method. It's essentially the same core trading system. So when somebody comes up with a great idea, and I get a lot of great ideas from other traders, they're going to share them with you. And we're a very supportive community. And that's what you're going to find in the trading room. Traders who want to help you and help make you money. And I get great trading ideas from traders in the room. Now, the whole thing is $997. You do not have to enter the promo code. Now, if you order today, you get the market scanner lifetime. And if you order today, you'll get the master class I just did. You're going to get a new master class. You'll get the old one I did about 2 weeks ago. But what's really important about getting a live master class is you get the questions answered that you want answered. And there's always lots of unique questions. And the master class usually lasts the whole day. I mean, I always schedule it for an hour, but they always go 2 to 3 hours. The last one I did, I think, was like 2 hours and 15 minutes. And we will give you that one on a link, but we're going to give you a new live master class. So look, if you're making money every day, maybe I can help make you a little bit more. But if you're treading water, if you're having problems trading, if you're using this old stuff that is never going to make you profitable, I urge you to take action, because I'm telling you, this software works and I trade it every day. And here's the promo code. Now, again, if you want to lock it in, just put in your name and number, and we are never, ever going to hassle you. We will call you once. And if you want to come aboard, you will. If you want to take time, you can think about it, but you're going to lose the scanner, and you're going to lose the masterclass. But you will lock in the 997. So there's no downside to putting in your name. Rory will call you today, and if you have any questions, he'll be happy to answer them. Now, I'm going to answer any questions that you have right now. Now, if there's anyone from our trading room, we're asking me stuff about that, that's not something I'm going to answer, because I was in the trading room today forever talking. Now, I did not put in here that you will get a month in the trading room, and that will appear on the receipt you get at the time of purchase. It'll say Market Scanner, Forex Swing Trading Masterclass, 1 month in the live trading room. You will come in. I want you to spend a month with me. Now, that's the only recurrent charge. If you decide that it's worth the cost, it's going to be $199 a month, but that's totally up to you. Everything else is for good. And I told you, if we make it better and we do upgrades, you get them all. So let me go to the top and quickly go through any questions. Hey guys, hey is a shining example of one who teaches, okay, hold on a second. The banks are stiff suckering traders. I agree with you. You too. Hey, Nick. Mark, it's called swarm behavior patterns, aggregating around B and golden means, golden mean, and all the patterns in nature, as you said. The reason that people fail with fibs is because they are oversimplified and or misused, in my humble opinion. Well, you know what? Here's the thing, Nick. You may be completely correct about that, and I've actually heard that before. Here's the problem: the Fibonacci retracement levels that you're going to get all depend upon the swing high, swing low that you choose. And people are always creating, maybe looking at differing swing highs and differing swing lows. Over the course of a 3-hour period, maybe they're not taking that 3-hour swing high and that's 3-hour swing low. If everyone was taking the same swing, then I would think that you're 100% correct. But I think that traders are taking multiple different swing patterns. That's another reason I believe it fails. But I do agree with you, and what Nick is saying is that if enough traders take the same swing high and swing low, and they create the same Fibonacci levels of support and resistance, it's sort of a it creates a mindset, and he calls it, I think, in a very sophisticated way, he calls it swarm behavior, and that is true. I just think that traders oftentimes use different swing highs and different swing lows. That's all. But I don't think fundamentally, Nick, that Fibonacci in any way other than that swarm behavior actually is telling us what buyers and sellers are thinking above and beyond what you just said. And the only thing that we really care about when we trade is what big money is telling us. Because if big money, if a big bank is buying a Forex currency pair, it's going to walk through Fibonacci like butter. And that's another reason why I think it consistently fails. But your point's very well taken, and that's why I wanted to read it out loud in the room. And I'm very articulately and sophisticatedly put. Okay. Yes, yes. Okay, hey, Ray. Does your system eliminate entry signals that occur when a trend is weakening or nearing its end? It does, Ray. And in the master class, what Ray is talking about is when we see the trend weakening, does the system avoid entry signals in those particular times? And we do. And here's the thing, Ray. Order flow is very, very sensitive to buying and selling pressure. And you're going to find that as a trend weakens, you lose order flow fast. Also, there is technically overbought, oversold conditions. We know that a market can be overbought or oversold for days, weeks, and even months. But we use a very unique way of calculating overbought, oversold that's totally indicator independent, which I will teach you in the master class. And as the market moves into overbought or oversold territory, the chances are that the trend is beginning to weaken becomes greater and greater and greater. It's another way of making a risk assessment on your entry. The tighter you trade to mean price, which is the 50, the more likely you are to get a nice juicy entry and a nice runner. As you start moving off a mean, the likelihood of getting a runner diminishes and then a winner diminishes. And the revolution system takes that into account. And I don't have time to show you the inputs, but it does its own calculation, and I will show you those inputs in the master class, because what you say is exactly correct. Every trade does wear out. Hey, Robert. It does. The higher time frames are irrelevant. Robert, this is a time frame independent system. If you want to trade a 4-hour, if you want to look at a 4-hour chart, the higher multiples are going to be 4 times 3, and which is 12 hours, and then times 3 again, 36 hours. You're not going to get many alignments, but when you do, you're going to get a big move. And we have a lot of traders trading daily bars. I just want you to know that. A lot of overseas traders trade daily bars. I don't know why, but they do. And so if this was time frame dependent, like you can only swing trade it or day trade it, it'd be broken. Any system has to be time frame independent and instrument independent if it really is capturing the underlying mathematics of the trade, of market movement. How do you determine when to get out, capture the whole move without giving back on the retracement? It's really simple, Robert. What we do is, based on the instrument, we're going to give you a first target and second target, which we've calculated based on the average true range of the instrument. So, and also based upon your risk assessment and your goals. Like if you just, there's some traders who just want to, they want to scalp. And I don't like scalping and I recommend it, but they just do it. But I'm going to go back quickly and show you something that's very unique to this system. I'm not doing this now. Let me show you a good example of it. Now, you see this line here? This is a 15 EMA of a 15 EMA. Now, if you put a regular 15 EMA over it, you're going to see that it wiggles more. It's jockeyed around by price more. This has more stability, but it moves almost as fast. You're going to take out your trade in two sections. Let's say you're trading two lots. Your first lot is going to be at a predefined target, which we're going to recommend based on the average true range of the instrument. The second is going to go out on the change in color of this 15. So you're going to stay in this trade until it changes color. Now, obviously you're going to give back money, but the upside to this is you can capture 60 and 70 pip moves. And the only way you can do that is by taking the trade out on the change in color of this line. And that's going to determine where your second parcel, or if you're trading two lots, your second lot is removed. Now that's optional. That's what we recommend as your automatic trade management strategy. You don't have to use it, but we recommend it. And if you do it this way, you're going to capture some really, really big moves. You're going to give back some on the retracement. And if you want to just set two targets, we'll give you the two targets based on the currency pair. And you can take one lot out at a certain number of pips, second lot out at a certain number of pips, and maybe you're perfect. It goes another 2 pips and the trade's over. But maybe it goes another 14 pips. And if you were out on this line, you would be able to capture it. There's no right or wrong on that. It's all based on your risk tolerance. That's not where I can say, here's the right way to do it and here's the wrong way to do it. It's simply based on what works for you. That's all. Okay, Robert? Hey, Paula. I have a scanner, Paula. How do you trade 60-minute charts? We're just going to configure the platform for you on a 60-minute. Paula, your next higher multiple is going to be 3 times 6 is 180 minutes, and the next higher multiple is going to be 3 times 180, whatever that is, 540 minutes. And you can trade a 60-minute, no problem at all with that, honestly, with that. And you can configure the scanner. And I think we actually have the scanner. See, it's configured on a 1 hour. If you're trading a 1 hour chart, these are all buys. Now, these are on stocks, but it works the same. You're going to get buys and sells on this scanner. Hey, Umar. Hey, Frank, thanks for your name and number. I really appreciate it. Paula, what it does is it scans all of the independent variables that go into producing a triangle. If it just gave you green at the triangle, you wouldn't get in time. So when you open up the chart and it says green and buy, it's simply a very high likelihood of getting an entry signal at that period of time. There's no absolute guarantee that you're going to get one. But remember, I'm going to show you some discretionary methods for trading that are really going to make this a little more versatile, actually a lot more versatile than just the revolutions entries. And if you trade time-based charts, there's some really, really powerful ways of trading that I don't get when excuse me, I'm just getting tired. But on Forex, I trade time. On stocks, I trade time. On futures, I trade Unorenko. So when we trade Unorenko, we don't have the ability to leverage certain things that trading time does give us. And there's some very powerful ways to make assessments on time that I really, really like, that I'm going to show you. And in the master class that I'm going to send you on a link, you're going to see those patterns. They're recurrent. They're not rising and falling triangles and all that. You know, all that salami. There's something else. But let me tell you, they freaking work. Thank you, Craig. Craig said it's amazing software and very reasonably priced. Listen, I mean, normally it's at $3 grand. And if you go to our website and check it out, it's $29.99. We're really discounting it. Okay, great. Thank you, Robert. Appreciate your Skype. Okay, Lila, you gave me your phone number overseas. Is it possible for you to give me your Skype name? Now, if you don't have a Skype, you have got to accept our call when we call you on WhatsApp on your phone. It's the only way for us to contact you. So if you can put in Skype, we would prefer it, but we'll call you on WhatsApp, but you got to have it downloaded on your cell phone, or else we have no way to call you. We don't do it. Our phone system is only set for United States and Canada. We don't go overseas. We can still reach you if we really need to, but it would be more helpful if you could do that. Umar, just call Rory about that. He's a really nice guy, okay? Yes, you were. I'm not sure, Craig, what that was for. Frank, you just speak to Rory about that. Like I said, Rory's a super nice guy. I attended another presentation, but seemed like it. Sure, we have this optimized uniquely for futures, for Forex uniquely, and for stocks. Remember, the underlying principle that governs price mechanics on every financial instrument in the world is based upon price movement on institutional money. Now, each of those systems is different because they have their own styles. And the pip spread creates a little bit of a unique barrier that we need to overcome. But this software, with its variations, has a futures version and a stock version, and this is our Forex version. And I'll tell you, I used to get up at 2 o'clock in the morning Eastern time and trade it every single night. But I'm a single dad. I have a son 24/7, 365. Used to get up at 2 o'clock in the morning, trade the Forex, go to bed at 3:30, wake up at 6 o'clock in the morning, make his lunch, take him to school, go to bed at 7 o'clock in the morning, and get up at 9 o'clock in the morning, and then trade futures. And after 7 months of that, I was ready to be admitted to a mental institution. So I just couldn't keep it up. So if I trade the Forex, it's going to be, you know, it's going to be in the evening on the open of the Asian session and the Australian session. I'm not going to trade it. In the mornings, I trade futures or stocks, and I'll trade the Forex on the Australian and Asian open. I just can't get up at night. It's too much for me. Hi, Ray. That's, you know, I answered that question, but it's good to reiterate. It only works on NinjaTrader 8. But if your data feed from your brokerage account, many of them do, and the brokerage puts them there for this purpose. Sergio will bring it over and will run NinjaTrader 8 for you for free. Now, I know eSignal does, I know Interactive Brokers does, I know Thinkorswim does, I know Owanda does, and I know there are others. If you have a different broker, just send us an email or call Rory. He'll answer your question in a second. The worst downside for you is you have to open up a NinjaTrader account. Like I said, it'll cost you $100. You leave the $100 in and you never touch it. It'll give you the signals and you'll trade your brokerage account. There's a lot of traders doing that. Hey, Ray, how long does a new trader, you know what, Ray, it's a good question. How long does it take for a new trader to become confident in the system? And you know what? Some traders, it's a week, and some traders, it's a month. It's so individual, Ray. And remember, some traders have never touched a mouse. They're just brand new. And other traders have been trying to trade successfully for 2 or 3 years. So they pick this up very quickly. So, I mean, you can see the platform's very intuitive, and we make it very easy to trade. And being in the room with me, you know, we trade for maybe an hour to an hour and 15 minutes. We hit our profit target, we stop. And then all the rest of the time I spend teaching. So it's a long teaching experience. I mean, I rarely close that room. Like, I was in that room 3 minutes before I opened up this webinar. That's why it was delayed, because I was still talking to traders in the trading room till 3 minutes to 1 p.m. Eastern time. And we finished trading early this morning. So your learning curve is going to be very, very, very quick. It's not difficult to learn. It just isn't. I take every signal, Ray, and you're going to see that I do. I take it with Chart Trader up. My stops and targets are projected. And at the end of every session, you're going to see that I bring over my profit loss. I have tremendous transparency in that room. Win-loss ratio, I'd say it's about 75%. I would rather underestimate than overestimate. But remember, Ray, we get those big runners on the change in color of that 15. Like, you get one trade where that Forex, that currency pair, just bites the wazoo, so to speak, or it just goes crazy to the upside, and you're on that 15, you're gonna ride that thing up for 30 or 40 or 50 pips, you're done for the day. So the win-loss ratio is obviously a critical component of a critical metric. But also, if you take 2 or 3 tiny losers and then one trade that goes 60 pips, it becomes a lot less relevant. But I'd say about 75% or more of your entries will be winners. All you have to do is have patience and discipline. You just can't overtrade. You have to take the low risk entries, and I'm going to help you find those, because those are the ones that I take. Hey, Kamal, thank you for your number. It is my Skype ID. Okay, great. We have your Skype ID and number. I appreciate that. Hey, Craig, if you already have had the software, sure you can, Craig. I would never not let you do that. Craig has the software for different. I think he probably has it for futures, and he wants to know if he can attend the Forex training. And of course you can, Craig. You're one of our family, man. We're gonna add you. When we purchase, do we have to pick a version, or one purchase covers all, Mike? You don't. Hey, Robert, what times are the Aussie and Asian Open Eastern? Okay, well, the Aussie Asian Open is 8 p.m. Eastern time, Eastern Standard Time. So you can extrapolate that. And you can just Google it too. It'll tell you the exact time. I mean, if you look at Forex Asian open time, it'll give you the exact time. Hey, Eddie, is the price the same for people who own the other software? You would get it if you talk to Rory. You would get it at a big discount, Eddie. Eddie said, by the way, Rory is the bomb, and Rory really does bend over backwards to help all the traders. I mean, it's really, I mean, it really is our goal to make you guys money, to have you guys gain the ability to make money. We're really, honestly, we're different. We really care about you. And that's why I don't charge for a 2.0 version. That's why I don't do a recurrent charge on a yearly basis. You know, I mean, I mean, your heart sinks when 12 months from now, if you love the software and you see, you know, we knocked you for another 1,000. I just don't like it. And so I just don't do it. And we've been in business 10 years. And I have never done it in 10 years. And I've been upgrading people who purchased 9 years ago, and they're still getting new software. And so, you know, I'm good to my word, and you're going to see it on the receipt that, you know, add-ons and upgrades are always free. So, you know, get that in writing. Can you post your phone number? Sure, Lila, the phone number is right here. Right here, 786-732-4656. And I'll just leave that up there, Lila. Hey, Craig, it was the most excellent training, great explanations. Mark is a very good teacher. He even talks about his mistakes as well as the successes. Thank you, Craig. So one thing, and it's true, one thing I don't do, you know, when I take a lousy trade, I talk about it. And you know, I don't just talk about it to be transparent, I talk about it to help me so that I don't take that kind of trade again. It's how I improve my own trading. I mean, I'm not, you know, I'm here to be successful. Hey, Ray, is there any ideal lot size? No. The ideal lot size is what's good for your account, Ray. I think it's hard to trade one lot because you always want to split the trade into a first and second target, you know, where you lock in some profit. But I'm telling you, I have so many traders in there that are just scalping. I don't, you know, 5 lots off at 5 pips. But I mean, my recommendation is if you trade, don't trade one lot, trade 2. And lock in profit on 1. Bring your stop to break even. And then look for that second lot to give you the home run. If it doesn't, no harm, no foul. Eventually, you'll get the home run, or you'll get the double, or you'll get the triple. But beyond that, it totally depends on how much money you have. Really. And so there's no right or wrong. I just don't believe you should do one. Hey, Robert, you think I know having the, oh, you're the Russian, you haven't even, Robert promised me a Russian bride and he never delivered. You know, I'm telling you, that's, you know, that's where you got to put up. Give Rory some praise. He's been awesome. Unlike the guy that blew me off the day I drove down. Oh, that wasn't me, Robert. I swear to God. I swear. But I thank you so much, Robert. But you haven't sent me my Russian bride yet, so I'm waiting. You know, I've been single for 14 years, and I'm waiting for my 25-year-old Russian bride to come. Hey, thank you, Eddie. My pleasure. Hey, Nathan, can you get the trading room? How much money? The trading room for 1 month comes with it. If you just want the trading room, it's expensive as a standalone. But if you talk to Rory, either via email or by call, he may work out something with you for it. I always defer to Rory on that because I let him do that, Nathan. Can you automate this process to take trades when you're not able to watch? Well, Lyle, we're working on the automation. It's very, very difficult. And we've been working on it for a few months. But those triangle entries we are ultimately looking to automate. And but I don't want you to be misled. This system is not automated. It will show you the triangle. You have to press your mouse. But we are working on the automated version. I just want you to know that. We'll phone ASAP. Have to eat supper first. Okay, Lila, we'll be here. Hey, Robert. I had her in the car that day. Oh my God, Robert. Did you have her in the trunk? Hey, Lyle. Semi-auto is better. Well, Lyle, if it's auto, you always have your own discretion. You always have the discretion to turn it on or turn it off. Okay? No, I trade every day, Ray. I mean, I trade Monday through Friday. I didn't trade yesterday just because I had an obligation in the morning, but our trading room is open every single morning. I mean, we trade Monday through Friday, unless the markets are closed, it's some kind of holiday. Otherwise, we are open and we trade. So listen, thank you all for your name and number. There's still time to put it in, and we'll give you that call, and you can lock this in. And you're welcome to give us a call. There's our phone number. And like I said, if you come aboard, I will do everything I can to see that you guys make money. Thanks for the Unirenko setting. I've devised a pretty successful method. Great, really nice. Well, I should quit. I have 3 traders to call over the weekend, Robert, who all want to talk to me about little things they've noticed that can help us trade. All right, everyone, have a really, really wonderful afternoon. Have a great weekend and stay safe. I don't know how much this COVID thing will affect each of you personally. In Miami, it's supposed to be a big deal, but none of us are sick. They've closed all the businesses. We've had to make some adjustments to keep ourselves open, but stay safe, relax, enjoy yourself. And I'll just close with this. All the advertisers, the scam artists, they say, if you buy their system, you will trade stress-free. Well, you know what? Unless you're a robot, you're never going to trade stress-free. I've been trading for 10 years, and every time I click my mouse and the trade starts to move, I always get anxious. No matter how certain I am it's going to be successful, there's always stress involved. So that's why it's really important on the weekend. You really relax your brain and just enjoy yourself. And if you want to get some chart time in, it's good too. So take care, everyone. Thank you so much, and hope to see you in the trading room. Take care, everybody. Bye-bye.